It's been quite a journey for you, an intellectual journey over the year so far. I want to go through a couple of headlines and you help me understand why you've changed your thinking somewhat. It was only back earlier this summer where you said, I changed my mind. The Fed needs to cut rates now. Before the Federal Reserve meeting last time around, you said they need to go big now. I think they will. They did. This morning, my hard landing forecast turned out to be wrong. Bill, just walk us through how you're thinking about things currently and what kind of policy this backdrop needs.
Well, my original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a half a percentage point, trigger the Sahm rule. Check. But the Sahm rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting, they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing. And that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. Still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Federal Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing at all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
Bill, what are you expecting for tomorrow?
I think it'll be a decent payroll employment report. I mean, I think the estimates are around 140,000. That seems like a reasonable estimate. We have to remember, though, the payroll employment has a big standard error around those estimates. So you could get something like 80,000 or you get something like 200,000. And it really wouldn't tell you for sure that the economy has actually changed momentum.
Bill, how difficult is that in the November 7th meeting going to be, considering how messy the data might be, considering we might not have an outcome from the election? Can you think of a time like this one that they're going into in the next month?
Well, the particular awkwardness is that there'll be another payroll employment report during the blackout period right before the FOMC meeting. I think that most of the momentum is for 25 basis points at this point. Powell basically foreshadowed that in his speech. The fact that you had all these people in the summary of economic projections that only had one more rate cut in their forecast after the last meeting also tells you that it's probably not going to be 50. So I think the basic story is still intact. Risks to the labor market are greater than the risk to inflation. Monetary policy is tight. We're still quite a ways from neutral. So 25 basis points is the most likely scenario in my view at this point.
Bill, we had Adam posted on earlier from the Peterson Institute, who said that the Fed should be vocal about the fact that they're considering the deficit and potential tariffs as a potential inflationary pressure heading into 2025 and a reason to cut less. What do you make of that? Not necessarily the Fed weighing in on that particular issue, but being more cautious ahead of next year because of it.
In my experience, the Fed doesn't, set policy today on things that might or might not happen in the future. I think they wait till those things either materialize or not. And so I think that the idea that the Fed wouldn't ease because they're worried that the election could result in a certain outcome that would lead to higher tariffs and higher inflation, I don't think the Federal Reserve would hold off because of that.